Money Show on ET Now. Now, it's World Environment Month, and we thought that everybody can do something for the environment, for the society around them, for the community that they live in. And when you ask, how can I do so? Well, it can be done even by changing your investment habits. ESG is one such method of investing that helps you be a bit more conscious even in your investing habits. It essentially is referring to a class of investing that is also called, by the way, as sustainable investing. So it looks at those companies that have a positive impact on, the society, on the environment as well. So let's say, for example, you're worried about climate change, then ESG will help you avoid investing in those companies that have a detrimental impact on air, land, water. If you're worried about the social aspects of life, for example, human rights, employee treatment, then ESG will help you choose those companies that have fair and equitable treatment of their employees and of the stakeholders. So that's essentially ESG investing. Now, as a retail investor, how can you as well adopt this practice? Well, we spoke to a renowned name in this theme and style of investing, Abhay Laijawala, the MD and fund manager at Avendus Capital Markets for Alternate Strategies. Abhay, thank you so much for joining us today on the Money Show. So I know I've given a brief background of what exactly is ESG, but who better than you to simplify it down for our viewers? So why don't we start with that?
Thanks, Mubina, and very happy to be talking about ESG, something that we at Avendus are very passionate about. ESG, environment, social, and governance, primarily refers to a focus on the stakeholder rather than just a shareholder. And what in effect it does is it basically redefines a corporation a corporation whose purpose earlier used to be to generate a profit. Now you look at an organization with a purpose together with generating a profit. So in effect, as I said, a shareholder to stakeholder perspective, an organization's relationship with the environment in which it works in, the regulator with which it works, the employees who are part of the organization, and of course, the shareholder. So it's effectively a 360-degree analysis or a 360-degree approach which goes beyond the traditional financial parameters. And honestly, maybe we'll talk about this during the show. The world is changing, and many of the disruptors, many of the drivers of change in the world today are going to be non-financial, and therefore the non-financial factors are going to become financially material, and hence ESG.
ESG as a concept has been quite an established one in developed countries, but what about back home? How has it developed, and do you think it shows promise?
India will have no choice. This is a movement that started in the world, and India will have to hit the ground running. And honestly, in the 2 to 2.5 years during which we have been looking at ESG, we pioneered the concept in February of 2019. In the 2.5 years, we've seen that a lot is happening in India at a very fast pace. Let's take the example of what SEBI has done. So you've seen SEBI move from the BRR to the BRSR. I think we have pretty detailed disclosures now, which focus sustainability parameters. And SEBI has said that, beginning next year, this will be mandatory for all the 1,000 companies. So I think that itself is a move. In addition, we have our homegrown ratings, ESG ratings agencies. So that itself also shows that the environment is becoming more and more conducive. And look at the number of mutual funds that there are. In 2 years, you have more than 5 to 6 ESG funds which have been announced. And look at the amount of money they're all collecting. So the point is that, all the drivers of ESG are beginning to come together very fast in India. And, this is really the way forward. India will not have a choice. India is one of the most climate vulnerable countries in the world. And therefore, India will need to embrace ESG probably even faster than the Western world, because the clock is ticking on many of the climate-related factors of which ESG is part of. So my sense is that India is improving on ESG. India is embracing it, though a lot more needs to be done, but there is no choice, and it's beginning to happen fast.
The last 5 years have shown the Nifty 100 ESG index outperforming the Nifty 50, even the Nifty 100 for that matter. What's the trigger according to you? Do you think that the big investors and investors around the world will be pouring more money into ESG compliant companies rather than non-compliant ones?
So what you're noticing is, the foreign institutional investors are all investing under the ESG style of investing now. And in the last 2 years, almost every foreign institutional investor that is investing in Indian markets is now or has now embraced ESG. So in that sense, the money flow from the FIIs is actually moving towards better ranked or whatever one may say, better ESG companies. And now with Indian investors also looking at ESG factors, we are beginning to see liquidity increasingly move into these stocks. So I think that is something that I could think of. And honestly, I think, governance is something which India has always been ahead on through whatever SEBI has done, through the earlier Companies Act that we had in 2012. So in that sense, governance was always very well established. And now the E factor is also being embraced. So to that extent, my sense is that liquidity is moving into better ranked ESG companies. And that explains the phenomenon which you talked about.
Okay. Abhay, the G part, that's governance, which you as well alluded to in your answer, has been quite problematic. I mean, it's been in the face of it so far, because we've seen companies where governance has been an issue, like DHFL, ILNFS, etc. Investor wealth has been completely eroded there. So in a way, do you think that ESG also helps protect the downside risks better?
Of course it does. Of course it does, because history has shown that companies which have had governance-related issues have been derated. And 4 and 5 years ago, the consciousness of governance factors was not so high. So you had governance-related accidents, but in 2 years, 3 years, those were forgotten if financial performance was very good. But I think a seminal change has occurred in the last few years, where serious lapses on governance are leading to a far more structural derating than what we used to see. So to that extent, you would tend to believe that if you focus on governance, then you would be protecting your downside, because as I said, when you see these governance related lapses, investors don't want to go back to those stocks. And where there are repeat incidents on governance lapses, it's becoming quite a serious issue, because a lot of institutional investors then want to stay as far away from that name as possible. And in the same sector, you will have companies which have had governance-related lapses trade at lower valuations relative to their peers, even if the financial parameters don't necessarily warrant a lower valuation. So the answer is yes. And I think this will become even more scathing moving forward, And it won't just be the G, I think it will be on ESG. India is moving very fast from G to ESG.
Okay. All right. So, Abhay, considering all of this, what percentage of the portfolio can be put in ESG?
Increasingly, I would say you have to move towards 100% in ESG, because the way the disruptions are happening all over the world, it will really be the ESG funds or the ESG style of investing which will be able to capture both the risks as well as the opportunities. Now, let me give you a very brief example. Up until now, and this example proves the point I'm trying to make of how things have changed for financial markets. Up until now, we generally needed to focus on macroeconomic variables, on tangible financial variables, and that was enough. But in the next 2 years, 5 years, and 10 years, apart from these tangible financial variables, macroeconomic variables, we will have to take into cognizance some of these non-financial variables or physical variables, such as climate change, the pandemic, deforestation, water security. Look at what's happening to international food prices right now. International food prices are going up primarily on account of climate change related factors. It's not just a drought here or there. The global increase in food prices is a manifestation of the shift in the climate factors. So all of these factors are going to be the bigger drivers of financial stocks. And therefore, these drivers are best captured through a focus on ESG, which goes beyond the traditional variables. One more example. Up until now, you had global financial crisis, we had the Asian financial crisis, we had the dot-com boom. Again, they were all financial events. But the pandemic is a physical event. It's not a financial event, but it roiled the financial markets more than any other financial event in the history of in financial history. So this is the example I'm trying to give, that all these future disruptions will best be captured through ESG.
Oh, absolutely. This pandemic has wreaked as much havoc, if not more, as the global financial crisis and the dot-com crisis did, which is all the more reason why ESG gains prominence. However, Abhay, just to be fair and to talk about both sides of the coin, if you could talk to our viewers about even the risks that may be involved in ESG investing.
No, it's so that's the whole genesis of ESG. Very simplistically, when you look at financial analysis, you don't necessarily look at the beyond financial factors, as I said. So you're not capturing the risks. But when you do an ESG analysis, you're able to capture far more risks. So let me give you the example. When you look at a corporation from the 360-degree lens, you are able to assess whether the corporation is resilient, whether the management is resilient. And therefore, it kind of gives you more tool sets. It kind of gives you a 360-degree understanding on what are the potential risks, but even more importantly, is this particular organization equipped to handle the risks or not? So for example, when we look at the companies, we do the ESG analysis, and then we speak to the companies as well, it becomes very clear that, so-and-so company is or does have far more resiliency than some of the other companies. Let me just give you a very brief example. And this is on cybersecurity. So I met with the CEO of a very large bank recently. And after all the questioning was over on NPLs, on this, on that, At the end, I just asked him this one question. So what is your view? How seriously do you view cyber security at the bank? And what is your perspective? And he looks at me for what seemed to be eternity. And he says, I think that cyber security is an even bigger risk today for banks, for financial institutions than NPLs. So if there is something that keeps me awake at night, it is not NPLs, it is not asset quality, but it is the worry, what if we have a cyber attack? So, this to me was a very reassuring answer, because to me, it proves the point that this CEO understands issues such as cybersecurity, and this particular bank is receiving attention on such critical issues, non-financial issues, at the CEO level itself. Now, of course, no one can predict whether a cyber risk will happen or not, but if the CEO is so concerned about it, then I would imagine that the bank has built enough firewalls or enough processes within to be able to withstand an attack, even if it happens. So, this is an example of how ESG, goes beyond the traditional factors. And the CEO said, no one has asked me this question. Everyone talks about NPLs, everyone talks about asset quality, everyone talks of credit growth, but you are the first person that's asking me on cyber security. And I said, maybe that's because I'm asking you as an ESG fund manager. So that's the point I wanted to make.
So moving beyond financials, moving beyond the quantitative aspects, ESG involves asking the qualitative questions which help capture the downside risks as well. I guess the proof is in the pudding. You have the Nifty 100 ESG index, which has outperformed the Nifty 50, the Nifty 100 in the last 1 year, in the last 3 years, in the last 5 years as well. Abhay, really appreciate you joining us today on the show and, breaking down this concept so simply for us and providing so many compelling reasons on why your portfolio as well should be ESG compliant. Well, let's take forward this conversation. We have with us now Deepak Khurana, Proposition Sales Director for Sustainable Finance and Lipa Asia Pacific at Refinitiv. Deepak, thank you so much for taking out time. Now, to start with, how do you identify an ESG compliant company? Because, the company may say XYZ things in their annual report and they communicates with investors, but are there any benchmarks that can help investors objectively decide on whether a company is ESG compliant or not?
Right. So that's a great point. So when you're thinking of so ESG, I would say that any company could be ESG compliant just by disclosing few some indicators, data measures. They could be ESG compliant. So I think generally the requirement here is to kind of shortlist the better performing companies, the better ESG performing companies. So approach generally varies basis who's trying to assess the company and the objectives they're trying to achieve. So if the point of reference definitely is an individual investor, they could simply rely on ESG rankings and high-level scores offered by firms like us. So we at Refinitiv, we do rank and provide scores on companies. So important point to note that the scores and ratings alone can't be used to shortlist the companies. For example, a world-class company can have a higher ESG ratings, but limited impact on green economy. So a bit of due diligence is required to make the final investment decision. On the other hand, if the point of reference is institutional investors like mutual funds, provident funds, so they perform a detailed research to identify better performing companies. Institutions study, detailed disclosures made by companies on various parameters under the broad categories of E, S, and G. They rely on disclosures made by companies through annual reports, CSR reports, at times specialized reports like ESG reports or climate disclosures. And also institutions, they also rely on data and resources offered by firms like us. In addition to reported data, we also enable institutions with our own proprietary scores, tools, and also the benchmarks. So companies are actually not just looked at in isolation; they are actually benchmarked with their industry and the country peers. So those are something which are enabled by, research firms like us.
All right. Deepak, let's talk then about how should retail investors invest in ESG? Do you recommend that they should adopt the individual company route or perhaps the fund route?
Right. So definitely fund is a preferred method to take exposure on better ESG performing companies. ESG research and investing is a very technical and a specialized job. You need to assess some very extensive research and analytical tools to assess companies' ESG performance. As I earlier made some high-level remarks on ESG alone does not complete the process and cut the whole bill. Rather, you also need to study companies' product and services and the impact that they are making on the green activities or on the green economies. So it's on a practical note, it's very hard for retail investors, individual investors to manage this whole technical process on their end. So I would suggest leveraging expertise offered by fund managers, the asset management industry in India to build a robust ESG-based portfolio.
All right, so opt for the fund route basically. And finally, Deepak, what are the challenges according to you in identifying ESG compliance?
Right. So it's a interesting question, and I think the people across the globe are talking about it, and there's I think very uniform some of the messages that are coming out from there. So I think I earlier mentioned that here in India we have this structure of BRSR through which the companies are being asked to disclose information. So, and if you go around and go to Europe, they have their own method of structure of asking companies, financial institutions to disclose information. Go to China, they have their own taxonomy. So as of now, we do not have one common standard across the globe on company disclosures. And here in India, as I said, we are still at the infancy stage. The whole all I think stakeholders, they are going through a learning curve. They are seeing what's transpiring in some of the advanced economies, specifically from the ESG point of view, like Europe, and they're trying to learn from there. So data standardization is definitely a problem. The data that is being disclosed here in India, comparing that, for a larger universe, while the top companies, they do look at the global standards as well, but from a larger universe, having a more comparable data is definitely a challenge. And also, as I said, the whole ecosystem around, having disclosures from, the other segments like financial institutions, which is more of a specialized job. So that's something which is going to evolve. As of now, there's a limited visibility around that. Just to, make some quick examples specifically from the retail investors' point of view. The ESG labeled funds, we have few of them now here in India. We just know that they are the ESG funds, which is what is beneath those funds. As of now, nothing is known. How much climate risk they are carrying, what kind of a scope 1, scope 2, scope 3 disclosures they have, that's something which is not known to the investors as of now. So, so while they are labeled ESG, but how, green they are, whether they are dark green, light green, that's something which is not known as of now. So it's, so as I said, the whole industry, the whole country is going through a sort of a learning curve. And as we move along, things will be, much better.
I really appreciate you giving us your time today. Thank you so much for joining in. With that, we'll take a very short break, but be right back. We'll be talking to the fund manager of one such ESG fund. Stay tuned.